All right, let's get right into it. We're going to take a look back at a moment that, honestly, changed everything. A time when the entire financial system we all rely on, well, it just seemed to break. We're talking, of course, about the 2008 financial crisis.
Just let that sink in for a second. The system that handles our paychecks, our savings, pretty much our entire future was right on the edge. And the craziest part? For most of us, it felt like it came out of nowhere. Just a total blindside.
And that's the big question, isn't it? How does something that massive, that catastrophic, just happen? How did nobody see it coming? Well, that's exactly what we're here to figure out. Let's trace the steps.
So, to really understand the crash, you first have to understand what the world looked like right before it happened. And, on the surface, things looked more than just good. They looked fantastic.
It was truly the era of easy money. The housing market was absolutely on fire. It felt like everyone was buying a house. And getting a loan from a bank, it was a piece of cake. There was this feeling, this widespread belief that the good times were just going to keep on rolling. It felt really secure.
But you know how these stories go. Underneath all that calm, a serious problem was brewing. A kind of hidden risk was being stitched into the fabric of the whole global economy. And it was just waiting for that first domino to fall.
And here it is. This is the heart of the issue. Subprime mortgages. The idea itself is pretty simple. It's just a mortgage given to somebody with a shaky credit history. Someone who, might have a tough time paying it back. But for a while there, these incredibly risky loans were seen as a goldmine.
Okay, so here's where things get really wild. The banks, they didn't just hang on to these risky loans. Nope, they took thousands of them, bundled them all together into these super complex financial products. The thinking was, hey, if we mix a few bad loans in with a bunch of good ones, the risk gets spread out, right? Then they got these bundles stamped with a top-tier AAA safety rating and sold them as safe investments to pension funds and buyers all over the world.
This is the perfect way to picture it. From the outside, the investment looked delicious, totally safe. You see that cheesy golden brown top and you think you're golden. But buried deep inside was this layer of risk that was just completely rotten, ready to make the whole thing toxic.
So what do you think happened when that hidden, rotten layer was finally exposed? Well, when people with those subprime mortgages started to struggle with their payments, which was inevitable, the whole thing just exploded. It wasn't about a few bad loans anymore. It set off this unstoppable chain reaction across the entire global system. And this just shows you how fast it all unraveled. It started with homeowners not being able to pay. That made the value of those lasagna investments completely tank. And because banks and firms everywhere owned these things, they were suddenly staring at unbelievable losses. It pushed some of the biggest names in finance right to the edge of collapse.
This was it, the moment of truth. That chain reaction hit the very heart of the financial system, and all at once, everything just started to break. Just look at that number. Over 20% wiped off the value of the stock market. We're not talking about a slow dip. This was like falling off a cliff. It represented trillions of dollars in value, just poof, vanishing into thin air.
And this is where real, genuine fear took over. We're talking about banks that had been around for 100 years, pillars of the economy, suddenly on the verge of failing. The term too big to fail was everywhere, but now people were starting to wonder, what if they actually can't?
Because this was never just a story about Wall Street bankers or numbers on a computer screen. This crisis slammed into Main Street, and it hit hard. The fallout for regular people was absolutely devastating.
This chart really says it all, doesn't it? As the whole economy just froze up, businesses closed their doors, and unemployment went through the roof. Every single bar on this chart, that represents millions of people losing their jobs.
Yeah, the human cost was just staggering. Millions of people lost their livelihoods. Families lost their homes. And folks who had done everything right, saved their whole lives for retirement, they watched their savings just evaporate. It created this deep, lasting sense of fear that stuck around for years.
So, when all the dust finally settled, what did we learn from all this? Because this isn't just a history lesson, right? The lessons from that wreckage are still incredibly important for all of us today. This really nails the shift in thinking. Before the crisis, there was this widespread belief that some things, like housing, were just a sure bet, foolproof. Afterwards, we learned a tough lesson. You have to understand and, more importantly, question the risk in everything.
The idea that easy debt was a good thing got replaced by a much healthier respect for managing it cautiously.
And that's why this really matters to you and me. Understanding how the whole system can go wrong helps you protect yourself. It helps you ask better questions, be smarter with your own money, and maybe build a stronger financial future for yourself.
Which leaves us with one last, really big question. Sure, the system was patched up. New rules were put in place to try and prevent this from ever happening again. But did we actually fix the deep underlying problems? Or are the same cracks that caused the 2008 collapse still there, just hiding beneath the surface, waiting for the next big shakeup? Is something we should all be thinking about.